everybody. This is Michael DeJoy, and welcome back to the Dash Trader Newsroom. And market volatility has increased as expected. And the summer has officially ended, and we have returned to market volatility concerns. My name is Michael DeJoy, the Director of Educational Services here at Dash Trader, joined by Jill Molandrino, Global Markets Reporter at NASDAQ. Jill, how are you?
Good, doing well, thanks.
Great to be here. And oil is going higher. How high do you think we will get as oil concerns continue to bring up inflationary concerns, something you and I have been talking about for almost 2 years?
Yeah, well, in terms of oil price, you're the technician, so I'll let you comment on that. But I think as it relates to what we're thinking around the consumer with student loans coming back online, we know gas is over $4. We know that we're dealing with potential government shutdown. We know that there's still a UAW strike looming, right? Who knows how long that will go? And then what do the terms of that deal look like? We know what happened with UPS when they had their union agreement. We saw the shipping prices increase. So what does that mean for cars? Depending on that deal, you know how the cost is going to get passed down. It's going to get passed down to the consumer. So it's just another avenue where they can potentially get stretched. In addition to, where I live, gas is $4 plus. I've heard anecdotally in Canada, it's like $6.50 in the LA area. So I think, in addition to oil getting higher, we just have to think about the trickle-down effect, because again, the consumers, 69-79% of GDP, they have been the recovery story through the pandemic. In fact, they have really been the story through every news cycle. So I think that's really what the story is here. We're also coming into an election year. Constituents don't like inflation. They don't like higher oil prices. So it's not just, what we see in the chart, but how it's trickling down through the economy and what that means, from a political perspective.
Yeah, it certainly is increasing prices across the board. And obviously we're seeing it in like the auto strike, right? Like, because people are now, because oil prices are higher, inflationary concerns, then you have people demanding higher wages, which is why we have all this kind of increased union activity from the Screen Actors Guild and the writers' strike, United Auto Workers. It's all trickling down into the economy in general. But not just oil prices. The markets have started to show some, I don't know what you'd want to call it, selling off. It's not really quite a sell-off yet, but certainly the markets have been down on these concerns, whether there are inflation. We're not really hearing as much talk about a soft landing anymore. In fact, we had the opposite. We had Jamie Dimon talking about interest rates as high as 7% in the near term. What are your thoughts overall on inflation? And the interest rates, and potentially there not being a soft landing, or is that still in the cards?
Yeah, we actually had this conversation with our chief U.S. economist at NASDAQ yesterday, and it appears that the market is pricing in a soft landing. Interest rates will be higher for longer. Labor market remains strong. A number of other metrics, in the economy remain strong as well. But again, the risk to this thesis of soft landing, right, is government shutdown, UAW strike, and student loan payments, and further stretching of the consumer. So that's really the three risks to that thesis. But as of now, that appears to be what the market is pricing in, is a soft landing. Inflation still feels high, even though data would suggest otherwise. And, by all metrics and based on the conversations that we're having with econ and macro strategists, that's their thought as well, that interest rates higher for longer and pricing in a soft landing.
Yeah, well, the two questions I had is like, I thought and again, we always get the government shutdown story or government shutdown narrative. But, I thought the last time that we kicked the can down the road, it was like a solution for a couple of years. Is this now the government shutdown problem related to the immigration problem? Like somehow the Republicans have brought this back up. And I thought we had a government shutdown solution like 2 months ago.
Well, it was a temporary solution. They have to come to some sort of agreement to pass the budget to keep the government open. I'm not sure if it's related specifically to, what's happening with the border and what they're arguing over. I'm sure there's a number of issues and pork added into the negotiations there to get these things passed. But the last time there was a solution, it was just kicking the can down the road to buy some more time. I think you have to remember too that we also had our credit rating cut because of
That's right.
concerns around fiscal management and a somewhat unstable political situation. So if they can't get this resolved, it's more than a government shutdown in my mind. What does that mean in terms of ratings agencies and their commentary and the impact of the dollar and
it could really spread to other areas of the economy in general if the government is not ability to come to a solution. But that certainly puts the soft landing in jeopardy. What are your thoughts going forward in the from the Fed? Obviously, Jamie Dimon came out, and we just had this latest Fed meeting that rates will be longer or higher longer. What do you think about the ability of banks to sustain through a period of higher interest rates for a long period of time? Certainly, we know that that's going to impact the consumer, right? We know that consumer spending and consumer debt is, up over $1 trillion, from where it was in the last couple of months. But certainly, what do you think how will the banks be able to hold off, considering that interest-based rates are expected to be higher for a longer period of time?
Well, it's certainly going to impact their margins. It's going to impact the mortgage businesses and the lending. I mean, it's not even just what's happening in terms of interest rates, but with the banking issues that we had back in March. I mean, that's an overhang as well. So they're tightening up lending. That's why one of the areas in the market that has been a bright spot, private credit, of course, as investors look for alternative assets for their portfolios. That's why private credit has been doing well, because funding has to come from somewhere. I think the other question is, how will this impact small and medium-sized businesses? And of course, as more private lending is coming in to fill that gap. But it's going to remain tight. And of course, if you think about the banking sector specifically, that's where they generate fees from. And now that they're going to have to start paying higher interest as interest rates or lower or higher, that's going to impact net interest margins as well. And then you're also seeing it where deposits are moving to other sources because they're paying so much higher in terms of the rates and the yields. So definitely squeeze there, but for the economy, lending and business growth is kind of what keeps us humming along. So I think private credit is going to continue to fill that gap.
I just have a question too. I mean, just my own thinking is that usually employment is the other number that the Fed looks at. And right now the consumer has been really strong, and really the consumer has been holding up the economy. But as employment also turns very quickly. Like when companies start cutting, usually they start making cuts very quickly. If they start laying people off, people stop spending when they don't have a job. Do you think that there could be a possibility where the economy could shift very, very fast? Like, if there is a large amount of layoffs, that the consumer could turn very quickly, whereas we've gone from an economy that was very robust, supported by the consumer, but as soon as, let's just say, large scale layoffs start, as companies continue to see pricing pressure, inflationary concerns, is it possible that we could have a very sharp turn in the economy and very sharp turn in consumer sentiment?
Well, I mean, of course, if that scenario does in fact play out, but we haven't really seen that on a mass scale, right? I mean, there's more positions available than there are to fill, particularly in the services sector. But we haven't seen that play out. Should that be the scenario? Of course.
And I certainly saw Amazon's hiring and stuff like that. So
well, I mean, that's seasonal. That's seasonal as well. But the labor market remains strong, which is why they're going to stick with their strategy. I mean, Powell was, in his comments, iterated that this is a skip, not a pause. So it's on the table that if they can't get this under control, that another hike could be on the cards. Certainly not cutting anytime soon, not in the first 6 months of the year until they get the data that they want to see. We're still far away from the core inflation target. So
do you think that Jamie Dimon's, what Jamie Dimon had mentioned, potentially 7% interest rates, do you think that that could potentially be in the cards in 2024? I mean, that's an election year as well. Usually election years are more turbulent.
they can be more turbulent. And I think, the Fed has also been politicized, certainly. So I would imagine they'll do what they can to keep it, at the levels that it's at now. But 7%, it would, the housing market isn't moving with the exception of new starts because they have the ability to, have more attractive rates than the used market. But it's going to be, for a number of reasons, and not to sound negative, it's going to be, a pretty contentious next 12 months, possibly even longer, depending on how, the political scenario plays out here.
Right. Well, thank you so much for your insights as always, Jill. And
Okay.
look forward to seeing you in 2 weeks.
I'm just trying to understand.
All right.
Sounds
Thank
good.
you very
Take
much.
care.
Have a wonderful weekend.
You got it.
Bye-bye. All right. Let me bring up my Dash Trader here. All right. So let's first take a look at just the markets overall. Last month's newsletter, we came out with, that there was a bearish engulfing bar, but by the end of the month, the markets had bounced a little bit off. But this month, let's just take a look. I'm going to go and show you how to change inside of Dash Trader. You can go and change and set more time. So I'm going to go back to 2020. And I'm going to make this a monthly chart, a 1 month chart. I'm going to hit OK. So we've pretty much stayed within. We only slightly pierced the low of last month's low, but you can certainly see that we had a 1, 2, 3, 4, 5, 6, 7 month rise in the markets. And then now we've had 2 down months. We do have 1 day left of trading in this month. But I don't think we're going to bounce that much up off the lows. So we've certainly put in 2 red bars, which is a kind of a reversal pattern. But we are still above the 10 and the 20 period moving average on the QQQ, which is the NASDAQ 100. Let's take a look at the SPY. SPY is a little bit more bearish. We did kind of pierce and sell off, but we are still above the 10 and the 20 period moving average on the monthly on the SPY. The one that really is interesting is Apple. We really saw a big pullback in Apple from the 195, 200 level all the way down to 170, but Apple still is in an uptrend. And obviously, so goes Apple, so goes the markets. There is a possibility we could get a bounce here in the markets. Certainly indicative of Apple being at its 20 period moving average on the monthly and still being in an uptrend. MSFT, kind of similar pattern to Apple, although we do have 3 down months on a double top on MSFT, which is Microsoft. And of course, we have Google as well, getting a red reversal bar at a double top area on Google. So all of the major tech stocks, we're going to take a look at Meta, which certainly made a tremendous comeback recently. Also Meta, you had a red bar last month. This month we're kind of hanging up there with a green bar here at the top. Now obviously that could change. We still have 1 day left, but certainly this is looking more like a reversal pattern after a 1, 2, 3, 4, 5, 6, 7, 8, 9 month stellar run in Meta. The one that's very interesting to me is USO. So you can see the big run up in oil since the Saudis cut oil production and oil refinement. Needless to say, big run up in oil. We could also look at the oil ETN. Oil ETN giving a big monthly reversal bar. This tends to track oil prices overall, pretty well. So that's OIL. And of course, we had USO, which is the other one that also is the oil tracking of futures in oil. GLD. So GLD, Gold has been pulling back, and that's interesting, but I think that also has largely to do with the strength in the US dollar. And that's because interest rates are expected to rise. So rising interest rates usually supports a strong dollar. We've had a tremendous run in the US dollar, and that's just being reflected in the price of gold. GBTC, Bitcoin. Bitcoin holding up pretty well, really kind of flat for the last 3 months, but certainly interesting as well. All right. Well, pretty soon, everybody should be getting ready. We are planning a November #1 best traders competition. So coming soon, not quite yet, but coming very soon. We have the #1 best traders competition. So we're going to have some early sign up in the very, very near future. That's it for our market analysis section. Stay up to date with all things DAS by signing up to our monthly newsletter, and simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, Dash Trader TV, and the Dash Newsroom reminders. Follow us on social media at LinkedIn, Twitter, Facebook, and Instagram. Thank you so much for having us and staying with us every 2 weeks. See you all in 2 weeks, and see you soon in the #1 best traders competition. Trade well, everybody.